Welcome everybody to LFB conference 2025, and always pleased to see guests from delegates from who travel an hour plus. So it's really good to see some of you make an effort to come from afar to see us. So we are filming, so I'm told. So if you want to be on film, stand up and say a few words. If not, keep quiet. Fire exits, I think, are through the doors here. We do have the press here somewhere, which is Susie from Farmers Weekly. Now, I just want to say that Susie doesn't do anything in public or present anything without running it past us. Okay, so feel free to talk freely if you like, because Susie is one of us basically. So she is here from Farmers Weekly, but anything that may go into press will have to come through us. Okay, facilities in here, and I think and on the way in there. So this is what we're doing. So we're going to talk about where we're ready for a Labour government. Okay, and it appears the answer is no. And then we've got some answers from my fellow directors here, Sam and Luke, and Emma from Accession. But I'm going to talk for a few minutes on the top 25% with Will Tongue, who's sitting there from Berries. And then we have the Rural Communities Mental Health Foundation in full, okay? And Kate Scott going to talk about the story. So then we've got food production at the end. Have a little discussion on a couple of topics at the end. So the most important thing is that we do have a bottle of wine, as we had last year, okay, for the most interesting comment or question from the audience, and I'll be asking you to vote on who from the audience deserves this bottle of wine. Okay, so I'll just introduce, hopefully, if I move forward. That's not working. Good job, I've got a technical assistant here. There we go. What was wrong with it?
It's just the arrows down there.
Okay, so it works on there. Okay, so that was the bottle of wine, which is the most important thing. So what we've got, a case study, okay, from Sam and Luke and Emma, and so this is Mr. and Mrs. Gedden, who are local farmers, and they've got a son called Armour. Well done, thank you. There we go. So it's Mr. and Mrs. Gedden and Armageddon. Okay, and I haven't told you about this, have I? I haven't even told them. This is a surprise. I hope it doesn't put you off. You do have a son, don't you? Yeah, yes. Okay, and they've got a daughter. Is there a daughter? No. Well, there is a daughter. Okay, and they have a daughter called. Come on, Rachel. So a daughter called Rachel, and I've got my notes here somewhere. And Rachel, guess where Rachel works? So Rachel works locally as a trainee assistant bookkeeper in the Halifax Building Society in Huntingdon. She's been a trainee for 4 years, okay, but hopes to get promotion soon. And she's got very, very high hopes of getting she's very ambitious and very high hopes of getting a good job eventually. Okay, so I think that is the introduction to your case study. Okay? Yes. So we're on to the case study, please. Okay, thank you very much. Okay, so we've got Mr. and Mrs. Gedden and Armageddon and Sister Rachel. Luke, over to you.
Hello, everyone. So we are going to present a case study. Thanks, Gary, for that great introduction. So were we ready for a Labour government? And probably, as you probably know and probably all aware, it's probably a not to that answer. So what we're going to cover today is just an update on the capital gains tax changes, the IHT changes. Sam's going to go through some of the partnership case study and what options are available, and I will go through a limited company case study as well. So just starting on the CGT changes. So effectively what we've got is the rates increased from 30th of October 2024, so gone from 10% and 20% up to 18 and 24%, so 18% for basic rate taxpayers and 24% for higher and additional rate taxpayers. Trusts again are at that 24% rate. The good news though is holdover relief and rollover relief for business assets is unchanged. So that does mean that there are still some valuable reliefs available. Business asset disposal relief again remains unchanged. So that first £1 million of capital gains rate is at 10% until April 2025. That does go up to 14% from 25-26 and 18% from April 2026. And the government have been sneaky and tried to catch some unconditional contracts that have a late completion date by making them the later and higher tax rates in there.
Just moving on to the inheritance tax, you've probably heard this quite a few times by now, but I'll just run through the reliefs. We've obviously now got the £1 million limit for 100% sort of relief on agricultural and business assets. That relief is shared, so nothing sort of takes priority. That's shared between the two reliefs. Anything over £1 million gets 50% relief if it qualifies as a qualifying asset for agricultural or business relief. Agricultural property relief is extended to management of the land under environmental schemes as long as they meet certain criteria, mainly being sort of their schemes on behalf of the UK government or approved bodies. The 1 million relief, and this is sort of probably what the case study is mainly going to be looking at, is sort of use it or lose it and making the most of that relief and spreading it amongst family members as best as you can, or trusts, or sort of potentially not limited companies, but the use of limited companies in the planning. Pensions, we're waiting for further details, but Emma might mention something about that briefly later. But from April 2027, they are expected to come into a person's estate and be taxed. Trusts, again, we're waiting for further detail, but anyone that had a trust set up or trust set up before the 30th of October 2024, we know that those trusts will receive £1 million allowance for agricultural or business property. And so if you had 3 trusts, they'll all get the 3 million. Any new trusts created after the 30th of October share the £1 million. So if you do have more than one trust sort of set up after then, they're going to share the £1 million limit. There's quite a lot to consider on trusts. They are a useful planning tool, but we'll sort of mention more about that a little bit later. But again, we're waiting for further information from the government. Moving on to the case study, this is Mr. and Mrs. Geddon and Arma and Rachel. But we've got a farming partnership here, father and son, 500 acres of farmland and buildings. There's 2 let cottages held in the partnership on the balance sheet, and the current balance sheet value is about 6 million. Father's will, a fairly sort of typical will of what we've seen up to now. Farmland and buildings are to pass to the son, the farmhouse being left as a life interest for his wife. The let cottages are to go to the daughter, and then personal cash and investments to go to the daughter. So if we look at the current position, you can see there we've got the assets, father's assets, just over 6 million in the partnership, personal assets of cash and investments of 300,000, so we've got an estate of 6.35 million. Now the inheritance tax under the new rules, so this is after April 26, because at the moment things are as they always were, there'd be 100% relief there. The inheritance tax liability when father dies after April 26, sorry, is £900,000, which, yeah, a significant sum. And it's then, the question is, how would you pay that tax liability?
So one of the options people have available to them is looking at insurance. So if, in this instance, if the clients didn't take any action but were looking to insure that liability, we could look at insurance of £900,000. I've done a scenario for a 70-year-old and looked at how much it would cost each year to insure that. Have we got any volunteers in the audience who might like to hazard a guess what that figure could be? Because there's Gary's bottle of wine up for grabs here. Is anyone? 25,000. Any advances on 25,000?
I would say it's higher at 35.
Well, actually, you are very, very close. £26,036. So, no, but that's got to be a contender, Gary.
A contender. That's the first contender.
Okay, so if we move on, if we just look at some fairly simple lifetime planning, so it's not sort of setting the world on fire, it's just using the release we've got available. If we say gifted 60% of the farmland and buildings to the son, the will says they're going to the son anyway, so it's just making those gifts earlier than would be. Then there's no capital gains tax on that gift because there's holdover relief because you're gifting business assets. And from an inheritance tax point of view, it's a potentially exempt transfer. So if father survives for 7 years, then there's no inheritance tax. It falls out of his estate for inheritance tax. If we then consider bringing Mrs. Geddon into the partnership and we gift some land to her, then again, no capital gains tax or inheritance tax because we're using the spouse exemption there. But what it already does, you can see that we're then utilising £1 million of relief for Mrs. Geddon and £1 million as well for Armour. That was his Armour, wasn't it? Armour. So, yeah, just simple planning. And at that point, father wants to give something to his daughter, so he gives the £150,000 cash to the daughter. And again, he decides to draw down on his pension to start sort of living off the pension income rather than drawing so much out the partnership.
So, again, I've looked at options if the gift's made to the son of the land and the 150,000 to Rachel in this instance, because that's going to take 7 years to fall outside of the estate. If death were to happen within that 7 years, what would be the cost of insuring that liability? So if we just recall what the figures were initially, so from 26,000 a year just over, the total cost of insurance over that 7-year period with what, as Sam says, is actually some relatively straightforward planning, you'd be looking at a cost of under 30,000 a year for a 70-year-old in reasonable health.
Okay, thanks, Emma. Yeah, so this is the position after the lifetime gifts, and you can see now we've got the £1 million there for father, 3 million of land for the son, and 1 million for his wife. And yeah, the father's basically gone from a liability of 900,000 to nothing, assuming he survives the 7 years or it's covered by insurance. Mother there, again, the £1 million there, but with her other assets, if she were to die as well, then subject to satisfying the requirements for business property relief and holding the assets for 2 years, again, there's no inheritance tax liability. So you can see it's immediately, just with some simple planning, gone from sort of just under 1 million to nothing for parents. The son obviously now has substantial assets, so there would be a potential inheritance tax liability there if he were to pass away untimely, because you'd hope that there would be sufficient time for him to do lifetime planning. But again, did you look at have you got the insurance on this, or is it?
Yeah.
So Emma can...
So again, we've looked at, well, what would be the cost of insuring this liability if something happened to son? Because obviously that could be devastating for a farm business, an untimely death. So to insure 280,000 for a 40-year-old, we're looking at, again, in good health, £26 and a penny each month. So on 300 acres, you're looking at just over £1 an acre to insure that. So you can see by taking advice and doing some planning that the cost to a business look far more manageable.
Yeah. Okay, if we move on, if we now look at just the position after father's death, again, it's fairly simplistic sort of slides, but you've got the land and buildings passing to the son under his will. The 2 let cottages have gone to the daughter. Partnership current account, what was remaining as father's, has again passed to his son. And the son has personal assets of 350,000, so he might have a house that he owns in his own name. Again, his inheritance tax liability, 390,000, but we would hope that he's young enough to sort of, there's time to plan, make gifts, plan for his sort of children. So with life insurance and lifetime gifting to his wife or children, then there's the potential to bring obviously that down to nil, just as we did for father. Mother there, potentially just looking at that, there was a £10,000 inheritance tax liability, but that's on the basis that she hasn't given anything away further in her lifetime, which she could do, so that could be taken down to nil again. So fairly simple steps, nothing sort of, as I say, that's going to set the world on fire, but that you can do to reduce that liability from fairly substantial amounts. Just quickly to run through some points to consider. I think it's everyone, the £1 million limit was use it or lose it. So if you can spread it amongst the wider family or use a trust, then, you know, the more £1 million limit sort of you can use, the better. I think you have to bear in mind that you can't give assets away and then continue to derive a benefit from them. So you have to measure up what income you would need to live on, and, you know, so you can't give away 100% if you're living off that income. You might have other sources of income, or things can be tailored, and we sort of, you know, can look at that as well.
Is it worth me just adding at this point, we touched on pensions earlier and them potentially becoming chargeable to inheritance tax from April 2027. So people that do need to replace income if they're giving assets away, then actually using the pension could be a really good solution in that instance. So you're actually further reducing your estate and your liability to inheritance tax.
Yeah, no. One thing that sometimes people forget about, if the land has got a bank charge, or it's charged to the bank, you do need to look at potentially refinancing that or moving security to other assets. Otherwise, if you transfer land with the debt attached, there are sort of more tax implications, and particularly stamp duty land tax implications. I think a big one, it's really important to review and update wills and partnership agreements. A lot of wills are very traditional in that they leave everything to spouses, and it's probably re-looking at those to make sure that the spouse has £1 million, as I say, before death. It doesn't just transfer on death. And also to make sure partnership agreements are in line with the wills, and, you know, a partnership agreement will override a will, so it's important that you look at them in tandem. Review assets that are held in the partnership and whether you can get the Balfour test satisfied. So in our case study, you saw that there were 2 let cottages in there. Under the Balfour test, that business remained wholly or mainly trading, so it qualifies for business property relief. So if it is possible, you should have look at the business every year, and potentially, if you can get more assets in that could potentially get relief, you know, sort of once the £1 million that you used up, you will get the 50% business property relief on those assets. That's a worthwhile thing to consider. Anti-forestalling rules, so yeah, gifts made after budget day, 30th of October 24, they now fall within the new rules. So if the donor gives things away and dies after the 6th of April 26, but within 7 years of gift, then that limit, the £1 million limit, you do go back and look at that, and it will use some of the gifts. And then just another IHT liability on land and property, it can be paid over 10 years, but you can see that on some of those sort of estimates, if you've got a liability of 900,000, 90,000 a year for most farming businesses to find is just not sort of justifiable. So that's a very quick run through of some points to consider, but I'm going to pass you over to Luke, who can run through the limited company.
Thanks, Sam. So another option just to state on for the partnership as well is potentially looking at some form of incorporation, whether that's incorporating the whole farm or incorporating a diversified business. So in this scenario, we've got Mr. and Mrs. Gedden, who have a trading company currently worth £2 million. So generally, we are slightly more limited in what we can do for companies, but there are still some options available. A lot of those are similar to partnerships in this instance. So one option would be, again, gifting shares to other family members or potentially utilising a trust just to remove some wealth or value from the estate. And the other option, which is slightly different, is introducing different types of share classes. So in this case, growth shares and freezer shares. So growth shares tend to be having a set base value, and any value increase in the company accrues to those shares, whereas freezer shares work the opposite way. They only accrue value up to a certain value, and then they don't accrue any further value. So if we have this fairly straightforward starting point, in, say, 5-6 years' time, the company is then worth £4 million, so doubled in value. If we go through both of those options, so in option 1, what we've implemented there is freezer shares for Mr. and Mrs. Gedden, and then for their children, they've had growth shares. So in this situation, the freezer shares are implemented at a £2 million value, so they only accrued the value of the company up to that £2 million that they originally had. At that same time, they issued growth shares and gifted those across to their children, and they have then since inherited the value. So in that situation, all 4 of them would have effectively £1 million worth of value, which keeps them all under that £1 million limit for business property relief. In the second option, what we've looked to do is gift some shares to children, but also gift some shares to a family trust. So trusts are very useful in situations where you want some additional protection, so say from divorce or other situations, or potentially if your children are under the age of 18, it could well be. So in this situation, again, there's a slight quirk in that shares, when they're valued under a controlling holding, which is generally either 50 or 75%, do receive an additional discount to that valuation. So in option 2, because the husband and wife there have a 40% combined shareholding, they would receive an additional discount of potentially 20 or 30% on the value of those shares. So that would reduce the value down from a straight 1.6 million to roughly 1.1 million. So it's shared between them is £500,000 each, which is quite a significant saving in that scenario. So again, just coming on to some additional points to consider, HMRC have stated that it used to be in the past that you could issue growth shares for relatively little value or nil value, but they have started to say that they are looking for hope value, because generally if you're issuing growth shares, you're expecting there to be some growth in value, so they're trying to tax that up front. So for a trading company, what we can do there is gift that with holdover relief. So if it's fully trading, holdover relief applies and there's no immediate CGT charge. However, if that company was an investment company, say held investment property or shares, for example, then there may be a charge to CGT. So it's weighing up whether it's worth paying that CGT initially on the hope value or holding on to the shares that you have. Again, most of the options that Sam went through still apply to this. So the 7-year rule applies for inheritance tax, so it's potentially exempt transfer. The main thing in this scenario would be to ensure that the company valuation is correct at the start, to get that base value for locking in the value of the shares and the growth. And HMRC will challenge that, and we're probably expecting them to challenge that further with the cap on the relief going forward. What we could do additionally to just having growth in freezer shares is changing the share class to alphabet shares, so A, B, C shares, which allow different amounts of dividends to be paid to different entities. So in the prior example, what we could have had is husband and wife have A shares, the trust has B shares, and son and daughter have C shares, for example. So you can pay different amounts of dividends to each of those. And that would work really well, especially into the trust for potentially school fees planning. So what you can do is pay an amount into the trust that can then be paid to beneficiaries. And the way it works is whilst the trust pays the tax, the beneficiaries will reclaim most of that from HMRC. So it's a very tax efficient way of passing wealth across to younger children. Again, as with the partnerships, if anything goes into a trust, we have potentially lifetime transfer tax on the way in at 20%. So that needs to be considered. But for trading companies, again, BPR should apply if it's into that £1 million. And we have the 10-year charges and exit charges to consider. But I think that is all.
Any questions, one or two questions at this stage? Okay. Yeah, we're just bringing a microphone up to you, John.
Sorry, I didn't quite get the hurdle value. Could you just explain that a bit slowly?
So that is effectively the value. So in that example, that hurdle value, the ideal value would be £2 million. So what you would do is you would lock in the value of those shares at £2 million for husband and wife. And then the growth value would be anything above that 2 million. So husband and wife will never go above that 2 million limit, but all the growth then goes to the growth shares. So that 2 million accrues into the growth shares. So that's how that works. That hurdle value is effectively the value you set for both. So it will be the undervalue or the overvalue.
Anthony?
Yeah, the case study you've just given is for all the information we know at the moment. What happens, if that changes going forward? I can't see it going, but I could see different allowances.
You mean the budget that's coming in a few weeks' time?
Yeah. Whenever this comes into force, can't remember the date.
Okay, yeah, April 26th. Yeah. Okay. Yeah.
So effectively, all we can do at the moment is plan and advise on what we currently know, which is as much as you know. Really, we've had the two small publications given the changes to the rules, so we can go on that and advise what we think you should be doing at the time. But if anything changes from between now and April 2026, then obviously all we can do is change our advice at that time. It's a difficult situation. Is all I can really say, is because we're as in the dark as you guys are at the moment.
It's not legislation yet, is it? There's not legislation yet, so it's got to go through Parliament. But who's got the majority in Parliament? So, okay, thank you very much. I think, Will, sorry.
Yeah, it's related to the point about it not being legislation yet. What's your advice in terms of getting on with making some of these changes? Because some of the accountants I work with are in the camp of wait and see what the implementing regs say before you make any changes, and others are, let's get on with it. I subscribe to the latter view because I think it takes time to move people along in decision making. What are your thoughts? Yes,
well, my thinking on this is that if all you're doing is fast forwarding something, if your will says it's going to where all the land's going to go, and if you gift it now, so all you're doing is doing it before you die, basically. So you end up in the same place. That's my thinking. So, and my thinking is get on with it. You press the 70 o'clock. Because it's 7 years to nil, but in the fourth year it starts dropping. So if it's something that's going to happen naturally in your family through your will, I would press the button now, because what's the downside? But perhaps your son, perhaps Armour might get divorced potentially, get married and divorced potentially, but there are ways around that as post-nups.
Rachel might get redundancy.
Rachel might get redundancy. Yeah. Watch this space, I think. If Rachel gets made redundant. Mrs. Farmer's Weekly. Susie?
Hello, yeah. I think we're waiting for some clarification on pensions about whether assets, farming assets in a SIP might qualify for APR. And the general thinking seems to be that it's highly unlikely. I just wondered what your thoughts are, and also whether there's any other sort of guidance that you're waiting for that that is really hampering decisions being made.
Good point, thanks. Do you want to say it, or John Richard do it?
Great question. So you're absolutely right that we don't know at the moment. We believe that questions have been asked, but they haven't yet been answered. So as we sit at the moment, we don't currently know whether agriculture and business reliefs held in pensions will be subject to 40% or whether there will be any relief on them. So, sorry, I don't have an answer.
Any estimate on when you might know that?
Probably later in the year, but yeah, we don't know. We are aware that questions are being asked and they're not being answered. So, yeah, that's not very helpful.
Richard, do you want to add to that? Sorry,
I spoke to somebody who was involved in the consultation from the pensions profession, and that question wasn't even on the consultation. Okay, so it's only been raised by practitioners. Yeah, so it's not only is there not an answer, it wasn't understood to be a question 3 weeks ago.
That's very enlightening, Richard. Thank you very much. So I think we'll stop there. So we'll have further questions later on. So we now, Matt, can we move on to, please? Thank you very much, Luke, Emma, and Sam.